So hello and a very warm welcome to today's webinar, Understanding the Project Risk and Rating Drivers of Gode Wind 1, brought to you by Scope Ratings. My name is Keith Mullin. It's my pleasure to be hosting today's session. And I'm delighted to be joined today by Marton Zempleni from Scope's Project Finance team. Now, on the 29th of April, you may be aware that Scope assigned a rating to the 556.4 million euros of senior notes issued by Gode Wind 1 to finance construction of this offshore wind farm in the German North Sea. Now, in a moment, Marton will take you through a presentation explaining Scope's expected loss approach to the risk factors of this project. And he'll also highlight some of the principal differences to the nearby Borkum Riffgrund 2 wind project. And also, Scope actually rated the 815 million euros of senior secured notes issued by Borkum Riffgrund 2 back in February. At the end of the presentation, we're more than happy to take your questions, so please do type these in as we go along. So without further ado, Marton, it's a pleasure to see you. The floor is yours.
Thank you, Keith, for the introduction, and also thanks for everybody joining. I hope you can hear me well. So in the next 20 minutes or so, I would like to quickly walk through this presentation and demonstrate some of the key rating drivers of the Gode Wind offshore wind transaction, for which, as Keith mentioned, we assigned a BBB+ rating at the end of April. And really would like to use this as an opportunity to compare it with one of the other offshore wind publicly rated by Scope Ratings called Borkum Riffgrund 2. And I believe such comparison, and hopefully you will see as well, provides an excellent example to demonstrate how our expected loss project finance rating methodology works. And just for those who are not familiar yet with our rating methodology, it is important to emphasize upfront that our ratings are expected loss ratings and not probability of default or PD ratings, as probably many of our competitors would do. And expected loss approach really makes the project finance rated methodology, in my view and in my colleagues' view, a very powerful and relevant tool, because investors in infrastructure debt, in project finance debt, and probably many of you in the call who deal in project finance, really likes this asset class exactly because of its robustness, its stability. And a big part of that stability comes from the good track record and experience on its solid recovery. So hopefully, as you will see, we can capture such good recovery in our expected loss approach. But firstly, let me just introduce quickly what Gode Wind project is, just in high levels. And people who have been following the offshore wind industry for a long time from the beginning may recognize this name and may sound familiar even if you haven't directly worked on this transaction. And that may be the case because at its time, at initial financial close in 2015, it did pop up in the trade press because it was, I think, the first, but definitely one of the first offshore wind project which was bond financed and subscribed for by institutional investors. So it's really very interesting and in a way a privilege as well to look back after 6 years from financial close to this Pathfinder transaction. So the project is an offshore wind farm in the German North Sea. It uses 55 turbines on monopile foundations, a proven technology today, and deploying the Siemens 6.3 megawatt turbines. For those who are not familiar with all the turbine models, this was at the time reasonably new in 2015 when financial close happened. But by today, it's probably one of the most widely used turbine model in the offshore wind space with more than 1,000 deployed worldwide. So by now, it's a very widely used model. We don't really see any unexpected design issue with this technology. The project reached mechanical completion in 2016, final takeover a year later. So now it has over 5 years of operational history, which is a nice track record for an offshore wind farm. The project was initially developed solely by Ørsted, but in line with Ørsted's strategy and the typical financial approach they have brought in an equity partner, another investor who took 50% shareholding in the project. And Ørsted typically does that to recycle capital so they can, they have enough money to invest in new projects. So initially, such equity partner was GIP at financial close, but following completion, GIP sold out and the current shareholders came in, and the current shareholders are a consortium formed by Glenmont Partners and the Renewable Infrastructure Group, or TRIG. TRIG is an LSE-listed fund focusing on renewables, and Glenmont Partners are also a renewable-focused specialist and knowledgeable investor. So in this structure, and let me just show a structure chart. It's a bit busy and maybe looks scary, but I can just highlight the key takeaways from the chart. In this structure, which is fairly typical for the Ørsted-led transactions, the asset itself, which is shown as project company or operating company on the chart on the left-hand side, the project itself is owned 50% by Ørsted and 50% by equity investors. And these two investors therefore have equal voting rights and a very detailed decision-making mechanism, which is governed by a very detailed partnership agreement. And that's a very important feature because the external financing, in this case, in the form of bonds, but in other Ørsted projects, it can be a bank loan. The external financing is only raised on the holding company level, holding the interest of the equity partner, which is shown in orange in this chart, or the issuer, Gode Wind 1 Investor Holding GmbH. And Ørsted does not raise project financing on an asset-specific level typically. So originally, the issuer issued the notes in the original amount of 556 million euros, but by the time of today, it has amortized over 50%. The notes are due in 2026, so just around 4 years left until notes maturity. Ørsted is not only a 50% shareholder in the project, but continues to maintain a very active part and a leading role in the project because they undertake all the operational and maintenance activities under a 20-year, largely fixed fee O&M agreement, and they also provide route-to-market PPA services to the project. The next chart just gives a very quick overview of the operational track record. As I said, the project already benefits over 5 years of track record. In terms of technical performance, the project has been doing really well. The turbines and the technology performed at or above expectations. So it has been strong above the warranted availability levels. In terms of performance, what's presented here are the revenue track record, and the black dotted line shows the original forecast on a P90 wind level prepared by the project. As you can see, in some of the years, and especially in the last 2 years, performance was somewhat below this P90 forecast, and there are two main reasons for that. One is maybe a straightforward explanation. In the case of a wind project, was relatively weak wind. And we've seen both in 2020 and 2021 was quite a weak wind years in the North Sea, not just in Germany and other countries as well. So this was something which we've observed across a number of projects and impacted Gode Wind as well. Beyond the relatively weak wind performance, an other issue which impacted somewhat the project was so-called uncompensated events. And that means a number of things, but probably the most important component of these uncompensated events, which was causing a level of underperformance in revenues, were unscheduled grid outages. So that really just means that there are grid outages on the transmission network operated by the responsible grid operator in the region, TenneT. Clearly, these grid outages are outside of the project company's control, and ultimately the project company does receive compensation, but that compensation is subject to certain grace periods, so only after certain time has elapsed, and even then it's not a full compensation. So clearly, larger than expected grid outages would negatively impact the project, but would be kept at some point. So let's look into the rating framework now and see how the project works under our methodology. And we have quite a detailed methodology and published a very detailed rating report. And for the benefit of time and just to keep it nice and brief, I'm not going to go into every detail, just give you and paint a high-level picture. But please check out the more detailed rating report on our website. And if you're struggling to find our report on the website, then please do reach out to either me or any of my colleagues, and we would be happy to help. So in our analytical approach, we break down the risks of any project into 5 so-called risk areas, which are depicted here as construction, operational risk, revenue risk, financial strength or financial structure, financial robustness, and lastly, the project structure, which includes legal structure and other considerations. And these are complemented by our recovery risk factors, which capture the risks associated with the recovery of the project. And all of these feed into our expected loss calculation. So I think in terms of this framework, breaking down the analytical into these risk areas, there is nothing surprising. Anybody who's been doing project finance before, this would be probably a similar approach taken by them as well. So hopefully this sounds logical so far. In our rating report, we typically provide on our cover page, which if you check the rating report, you'll see as well, effectively an executive summary on the key rating drivers for each of these risk areas. And we provide an explanation effectively in what are the most important factors which led us to arrive to certain assessment. And you can see the assessment risk area by risk area, which are shown in absolute, showing the absolute level of risk and are expressed in terms of what we call PD strengths, which shows kind of the likelihood of any problem emerging, and the expected loss strengths, which also takes into account the severity of such event. So for each of these events, you can see in the kind of orange and the green charts, the PD strengths and the ER strengths. And this also allows us to show you the relative contribution of each of these risk areas to the total expected loss calculated, which you can see on the pie chart on here as well. For each of these risk areas, as you can see, the evaluations are either in the triple B or a single A range, which means that we don't really have any specific weakness in any of the risk areas. There is no, if you like, fatal flaw in the project. All of these risk areas are evaluated as relatively strong in the investment grade space, which kind of overall drive the entire triple B plus rating. And maybe that's not surprising because ultimately we are talking about an operational project which has a good track record, deploying a proven technology, benefiting from fixed revenue stream under the German feed-in tariff regulation in a AAA country. So the fact that all of these risk areas are in the triple B and A range hopefully makes sense. What is quite obvious on the pie chart if you look at the relative riskiness rather than the absolute risk level over the areas, that the financial strength risk factor is the biggest driver, if you like, in relative terms, the biggest contributor to the expected loss, which also makes sense because the coverage ratios, although overall acceptable and adequate for the project given its good track record, would be on the weaker end of what we would expect from wind farms and definitely investment grade wind farms. In a forward-looking basis, the minimum and average DSCRs, debt service coverage ratios, are 120 and 125 times respectively. So these are on the weaker end, and ultimately one of the key reasons why financial strength was evaluated as, in a relative sense, the weakest link in the project risk assessment. We arrived to these overall risk assessment for all risk areas by doing a more granular analysis. And the way we do such granular analysis are breaking down the project risk into what we called credit impairment events. And on the right-hand side of the chart, you can see 16 credit impairment events listed. These credit impairment events is a very specific terminology we use. These are effectively default-like events, but a little bit broader definition than a payment default would be. But these are a very practical way of mapping risk, in our opinion, because ultimately these correspond to a question of what can go wrong in a project. And I think if you go to any credit committee or investment committee, what people typically and executives tend to ask on any project before signing off on new money is what can go wrong in this project. And that's exactly the type of approach we try to replicate here. So just to pick some example, in a typical project finance deals, even if some of these are not relevant to this transaction, construction delay can go wrong, an O&M counterparty issue can arise, or refinancing can go wrong. So these events replicate the typical events which can happen in a project finance transaction. So for each of these events, in terms of our analytical approach, we would calculate and evaluate the likelihood of something going wrong in relation to that event. And also, once you combine with the severity of the event or the LGD considerations, then we calculate the expected loss strengths of that event. So again, I think it's very transparent and very useful for that each of these events, you can exactly map how our evaluation adds up. So just to pick one example, one of the events which we call operational performance and budget, so something directly linked to the operational issues of the project, which is shown as the first blue line on this chart. The PD strength is BBB minus. That's kind of an evaluation of something going wrong in the operational phase of the project, but adding some recovery benefits as part of our expected loss framework, we arrived to a BBB plus expected loss strength. We also, it's a very busy chart, so unless you have super good eyes, which I don't have, but you probably don't see the details on this chart, but this is effectively a nice overall summary, which is part of our report, which we call the expected loss tree, which also summarizes all of these events and shows the absolute calculation in terms of percentage losses for each of these events and in terms of rating symbols as well. So this is really a very transparent framework where quantitatively you can see how each of these risk areas contribute to the overall risk assessment. Ultimately, the project's expected loss, the final evaluation, if you like, is effectively the sum of all these individual risk areas expected loss, which in this case of this project adds up to 0.15% expected loss. So how do we arrive from a 0.15% loss to a BBB plus rating? We effectively do it by mapping this expected loss number to our idealized default curves, which are shown for different rating categories on this chart here. So the expected loss would be 0.15%, but the idealized loss curves are a function of time and measured against time. So we also have to pick a time horizon for the project against which we measure its calculated expected loss. In the case of amortizing project loans, we effectively don't pick the legal maturity or the remaining tenor of the project, but we look at the what we call expected risk horizon, which is effectively the average life of the instrument cash flows or the duration of the instrument cash flows, but calculated at a 0% discount rate. In the case of this project, although the remaining time to maturity is 4 years, but again, reflecting the amortization of the instrument, the expected risk horizon of this instrument would be 1.88 years. So once you map the 0.15% expected loss against 1.88 years, that would map to a BBB plus rating against our idealized curves. I know it's a very busy chart, especially at the shorter risk horizon, but believe me, that's where it gets if you would magnify this chart. So that's just a very quick overview, not of all the details, but more the logic of our evaluation, how we got to the BBB plus rating and what details you can find in our rating methodology for Gode Wind 1. But let's bring into the discussion the other publicly rated transaction, which can, I think, highlight some of the exciting features of our methodology. So let's bring in Borkum Riffgrund 2, which is a very similar transaction in every sense. In terms of transaction and corporate structure, it also does feature the Ørsted transaction structure, where the project financing only relates to the 50% share of the equity partner of Ørsted. In that case, it's Gulf Energy. Borkum Riffgrund actually uses a very similar number of turbines, 56, although each of these turbines have higher capacity using the MHI Vestas 8.3 megawatt turbines. So clearly, if you multiply the two, the overall park capacity will be higher as well. Both projects are subject to basically the same German feed-in tariff subsidy regime, which they benefit from relatively high fixed price over a 10-year horizon. And both projects were using broadly similar debt sizing metrics when they raised the original debt. And the debt quantum is clearly higher for Borkum Riffgrund, but only roughly by the proportion of the project size. So if you compare the expected loss calculation of Borkum Riffgrund 2 and Gode Wind 1, Borkum Riffgrund 2 has, in an absolute manner, higher expected loss, but we still arrive to a better rating outcome for Borkum Riffgrund by 1 notch, which is A- as opposed to Gode Wind's BBB+. Maybe that is counterintuitive at the first sight, but if you think back about the idealized expected loss curves I just shown in the previous chart, and the nature of these expected loss curves, it is actually quite logical, because over time, as time passes along, you would expect within the same category, rating category, an increase in expected loss because the time passes. So the more things can go wrong, and effectively the reason that the rating is still higher in Borkum Riffgrund 2, because the incremental amount of the expected loss is less than what you would expect simply from the curve, expected loss curve. So on the next slide, we can also use the same charts we presented before for Gode Wind 1 and compare along the same lines with Borkum Riffgrund 2. So this is again a very powerful and useful tool to compare projects under this framework. What is very apparent from the charts, if you maybe focus on the charts on the right-hand side, which break down and show the expected loss strengths and the PD strengths for both projects, that the PD strengths are broadly the same for the two projects, which is not surprising because, as I just explained in a nutshell before, the characteristics, the nature of the project risk are very similar across the two transactions. Having said that, the expected loss strengths show a bigger difference because it depends on risk factor by risk factor, but on average, the uplift for recovery in the case of Gode Wind 1 transaction is 1 notch, but on average across the 5 risk areas, in the case of Borkum Riffgrund transaction, the uplift for recovery benefits is 2 notches. So although the PD strengths are comparable, and if we had a probability of default rating, we would probably have arrived to the same evaluation and the same rating in the case of two projects, but it is exactly our expected loss framework and the differences in our recovery assessment what makes the final rating between the two projects different. Again, this chart, it just shows that we can dig deeper and we can even compare the projects for each of these credit impairment events to show exactly what the differences are. I'm not going to go through that one by one, just highlighting that that's again a useful tool to compare projects. But then the real question is probably what drives the different assessment of recovery between the two projects, and which is, as I said, ultimately the driver of the different rating outcome between the two projects. And there is partly a very technical and quantitative reason for it, because effectively for a shorter duration, and Gode Wind does have a shorter duration, it is more difficult to achieve higher rating because there is effectively, in terms of calculations and the shape of the curves, there is less tolerance for any weakness in the structure. But that's a bit of a quantitative explanation. There is a much more interesting and a much more important explanation for the difference, which goes very much to the heart of our expected loss rating. And I hope it's a good demonstration as well of our expected loss rating framework. In both of these transactions, the debt has been sized on the back of the feed-in tariff fixed revenues, which last for roughly 10 years from the start of operation. But the useful economic life of the assets are around 25 years, and that 25-year useful economic life comes partly from the certification time of the key equipment, including the turbines, and also the permit which was given out by the Bundesnetzagentur. And that means that after the maturity of the FIT regimes, or the feed-in tariff regime, and the maturity of the nodes, there are still 15 years left in the life of the assets, which are against which the debt hasn't been raised, but it's still something which drives the value of the assets. And clearly, that's something which equity would take into account in the analysis. If you have, from a debt perspective, a probability of default approach, then going beyond that tenor is not really a relevant exercise. But if you have, and as we have, an expected loss approach, it is very relevant, because in any realistic default scenario, which would be followed by a restructuring event, that restructuring event would effectively monetize the cash flows of such tail period, the period after the maturity of the debt, as a primary source of recovery. So the value embedded in the tail is very important for the investors because it drives the recovery value of the project. So let's look closer into this tail period, comparing the two projects. So what is the cash flow generated during the tail period? it's obviously a function of the generation volumes, the electricity generated times the prevailing market prices, because at this time the project would no longer benefit from a fixed feed-in tariff. It would receive market prices. However, and it's a courtesy of the German regulation, it would still be for the next 10 years out of the 15 years still subject to a regulatory floor set at 39 euro per megawatt hour. But the price ultimately taken by the two projects would be the same. Now, generation, if you break down the factors which is shown in this table, the capacity factor, which effectively captures the wind resource, are very comparable across the two projects. That's maybe not surprising because they are both located in the German North Sea. They are not very close to each other. At least I wouldn't attempt to swim from one side to another, but they are part of the same wind region. They have the same number of turbines, but the turbine size is bigger in the case of Borkum Riffgrund 2, and therefore roughly the revenue generated as a result of that higher capacity turbines are roughly 1/3 larger in the case of Borkum Riffgrund 2. So that's revenues. What does it mean for operating cost, O&M cost? And quite interestingly, and maybe surprisingly first, the O&M costs are very much in line and the same across the two projects, despite the fact that Gode Wind is a smaller project. So why is that? There's probably two reasons for that. One is that Gode Wind is an older project, and clearly, and especially in these years of the offshore wind industry development, we have seen costs have coming down as the industry and participants became more comfortable with the assets. So simply the fact that Borkum Riffgrund contract was negotiated later means that the market was already more competitive from an O&M perspective by that time. But also another important explanation is that the expense and the cost base of the operator is not only but very much driven by the number of turbines, because if a wind farm uses a bigger capacity turbine, then clearly it effectively achieves an element of economies of scale for the operator. So I think that the fact that Borkum Riffgrund uses higher capacity is also of efficiency in the O&M cost. So if you put revenues and O&M costs together, then it's quite easy to see that overall profitability will be higher in the case of Borkum Riffgrund 2. Which means that the cash flows, the free cash flows generated during this 15-year period at any given market price assumption will be will be larger, and so not 1/3 larger because it's a function of revenue and O&M costs, and that additional free cash flow gives that additional benefit to a recovery calculation, which effectively drives a higher recovery percentage calculation for projects and ultimately drives the one-notch difference in the rating. So just to conclude on this note, it hopefully demonstrates how the expected loss approach can look beyond some of the more obvious risk factors in the projects and take into account consideration which are beyond the debt tenor but drive the overall value of the project and therefore is more relevant to investors. And on that basis, we believe that our rating is relevant to investors as well because it does capture that value. So I stop here and I'm giving it back to you, Keith, in case there is any question.
Good. Thank you very much for that detailed presentation and explanation, Martin. So as Martin says, please type your questions in. We'll be happy to answer them. So actually, I do have some questions actually, Martin. So if you don't mind, we'll go straight into them. And it says, do you take into account the identity and quality of sponsors in your analysis on the basis, of course, that project finance is non-recourse to sponsors?
Sure. Yeah, I mean, it's true project finance is, and this transaction as well, from a legal perspective, non-recourse to sponsors, but we believe in every transaction, even if the sponsors do not have a legal obligation to contribute funds in any capacity, like in this case, sponsors play a very important role because ultimately they are the ones managing the project and driving it through in case there is any problem. It's not the debt holders who do that, but the sponsors. But the way we reflect the sponsors is quite specific in our methodology because we evaluate sponsors, and I will touch quickly upon how we do that. The sponsor's quality, we do evaluate it, and that evaluation feeds into every single risk areas. In each of those 5 risk areas, it feeds into that, because ultimately this is an overarching issue which plays a role in the whole fabric of the project and that impacts all the 5 risk areas. And the way we evaluate sponsors is not simply just credit rating of the sponsors. It doesn't only reflect the credit quality of them, although clearly that is an important driver, whether they have the financial resources to intervene if there is any problem. But we also take into account their expertise in the specific sector, their commitment to that sector, how much extent it fits into that business strategy, what is the track record. So all these issues, which are kind of more part of the soft evaluation, feeds into our evaluation, and therefore sponsors are part of our analysis, even if there is no legal obligation to provide extra funds.
Yeah, yes, indeed, understood. And now, at the beginning of your presentation, when you broke down the project structure and you pointed out that you had a holdco and an opco situation, and the question is this: is the rating negatively affected by the holdco structure, i.e., obviously the financing phase at holdco, not at opco?
Yeah, it's a good question, and I think especially going back to many years when these Ørsted structure came up, if you look at the bank market as well, there were a number of banks who differentiated their appetite between just lending to standalone project finance structures and holdco structures. But the short answer is no. In this case, we did not differentiate, or the rating is not negatively impacted by the holdco structure. And that's mainly because the setup in the case of this project means that overall we believe that lenders have sufficient control over not only the 50% shareholding issuer, but the entire project and asset as well, partly thanks to the very detailed mechanics in the partnership agreement, where the 50% partner receives a very good control over the asset. Also thanks to the experience of Ørsted, which probably fair to say is the leader, or definitely one of the leader in the offshore wind space. And lenders do benefit from sufficient security in the issuer level through share pledge, account pledge, and an assignment of the contractual rights of the issuer to the benefit of lenders, through which they can effectively sufficiently control the project. So in this case, we didn't differentiate negatively. And very importantly, at least in the base case, there is no structural subordination because the project company, the company is unleveraged. There are certain very subtle scenarios, which maybe I'm not going to go there, but it's detailed in the rating report, in certain so-called emergency funding scenarios where something goes wrong with the project and Ørsted injects equity, but the issuer does not, where some subordination can happen, but it's a little bit contingent, and we don't really see that as a negative rating driver either.
Right. Okay, understood. Thanks for that. Now, what about revenue underperformance? How does that get reflected in the rating?
So the revenue underperformance is something which we take into account in what we call scope rating case, because we always carefully evaluate the issuers and the project's rate assumptions, and if needed, we make adjustments. And we use the past performance, of course, as an important indicator to change or and drive our thinking in terms of future assumptions. As I mentioned, there were 2 areas of underperformance. One was wind. And in the base case, we do use, and I see actually it's also one of another question, so maybe I kind of respond to another question as well now. We use P90 in our base case, and the issuer used the P90 wind as well. And that's true that in 2 years, there was underperformance against P90, but also if people are familiar with the statistical approach behind that, this is a so-called 10-year P90. So, the P90 level is something which we expect the project to achieve over a 10-year horizon. So those 2 years of underperformance from a statistical perspective, we didn't consider as weak enough to reconsider the wind forecast. So we did not change the wind forecast, but these grid outage events, which were not really accounted for in the original forecast, we reflected in the scope rating case and effectively assume the haircut, a small, exactly 3.5% to be precise, haircut to the project revenues as a result of the grid outages which happened historically and may continue to happen in the future. And therefore, this underperformance is reflected in the DSCR calculation, which drives our financial strength assessment.
Right, so just the answer to, in fact, there was a question about P90. So that's the base case, but so you're saying, just to clarify, you don't make any deviations from P90?
Not in the base case. We,
Yes.
of course, do calculate a number of sensitivities in the project, and a stress sensitivity on a P99 level would be also factored in our sensitivities and see if the project robust is enough. I don't really have the numbers in my head, but I believe even in a P99 wind scenario, the project performance and DSCRs would be above 1 times.
Yeah, okay. There's a couple of questions I've still got, Martin, which and one of them is this: what's the power price assumption used to assess the cash flows during the debt tail?
Yeah, that's a good question, because the power price is only fixed for during the debt tenor, but as I explained, we do reflect the value in the tail where power prices are not fixed. In this specific case, we've taken the assumption which is consistent with the floor price, the regulatory floor price, which is 39 euro per megawatt hour. And we did that for a number of reasons. Partly for consistency with other projects where the same assumption has been used. For example, Borkum Riffgrund, and the rating ultimately has to be consistent because ratings are relative ranking. But in addition to that, although 39 euro per megawatt hours sounds like wishful thinking in today's price environment, and we would be very happy to see it as a consumer, and therefore sounds overly pessimistic. It makes sense for 2 reasons. One is that when we look at recoveries, and this analysis is only relevant for recoveries, clearly already by definition, we're looking at the downside. We're not looking at base case, we're looking at something gone wrong, we're looking at kind of bad outcomes in terms of the project possibilities. So logically, it makes sense to look at a conservative price scenario. But also, this price would be only relevant after notes maturity 2026. And yes, prices are very high today, mainly driven by high natural gas prices, because in European countries, natural gas is the main driver of electricity prices. But looking in the longer term horizon, also as countries like Germany building out offshore wind farms, we see over time that price will come down, maybe to a slightly higher level, but I think longer term price levels are not inconsistent with the kind of 40, 50 euro per megawatt hour level on a conservative basis. I can't hear you, Keith. Sorry, I think you're mute.
Right, sorry about that. There's a question about interest rates, Martin, as well, which is, do you account for interest rate movements in your rating approach? As the question says, these will affect recovery value as well.
Yes, it's a good question. I mean, ultimately, yes, we do account for it, but it wouldn't be something where we shift the analysis because there's been a 50 basis point interest rate raised by the ECB or observed on the market. So this wouldn't be so granular, but it's right, it would impact recovery, and the way it does impact, we have to create an assumption for applicable interest rates and the expected debt return, as well as equity return in the recovery scenario. Because when we talk about recovery, we think about restructuring, and in restructuring, we think about the value equity holders and debt holders would demand for project cash flows, which has to be discounted based on certain interest rates. So clearly, if we are in a different interest rate environments, we would revise all assumptions on interest rates, which would therefore change the discounting rate. But it's not something where a slight difference in the market would change it. But over time, if we see a major shift, as it very well may be the case over the next couple of months and years, a major shift in the interest rate environment, we will also change our interest rate assumptions, which drives the discount rate.
Yes, indeed, that makes absolute sense. Okay, well, thanks for that. Martin, I have no more questions in the Q&A box. So unless you, those of you watching, have any more questions, let's get them in the next sort of 10 seconds. Otherwise, we are going to close. And so as we do move to our close, we will come back and do more of these project finance webinars, both on rated transactions and on project finance topics as appropriate in the future. So please look out for those, and we'll make you aware through our distribution channels. I had a question about the presentation. The presentation will be made available. In fact, we'll send it out to those that have asked for it. And if you do need the presentation, please reach out to Martin or myself via email, and we'll be happy to send it. So, Martin, thank you for your time. Thank you for your very clear presentation. I think it was well worth the effort. I found it very interesting. So thank you, and we'll see you next time.
Thank you.